Today, what we're going to talk about is the resiliency of this stock market. Everybody's wondering, how do we continue in the face of all the challenges, the election coming up, to continue to keep that floor under the stock market? The number one reason we're going to talk about is the income that stocks are playing today. So when we look at the market today, we always talk about the risk-free rate. So what is the risk-free rate in terms of investing? Well, that's the 10-year government bond. And what is that paying is going to be largely dependent on where money is flowing. So whether it's pension funds, it's your retirement funds, you're going to put that capital in the place where you're going to get the best rate of return. It's just pure and simple, right? It's just like if you're going to go traveling to Colorado, for example, skiing. There's two really nice 5-star resorts. Everything's exactly the same, but one is $800 a night and one is $500 a night. Where are you going to stay at? Obviously, the one that's $500 a night. Same thing with a savings account. If you know that Chase is giving you 0.25% on your savings, but across the street, Bank of America is giving you 0.5%, then why are you going to sit there and give your money to Chase? You're not going to do it. And so that's exactly what's going on today with the stock market. And what you're also really starting to see is that the money is starting to flow towards the stocks that are paying income. Today, for example, you look at a stock like Coca-Cola was actually up about 2%, whereas some of the big high-flying NASDAQ names that are not paying a dividend were actually down or slightly flat today. And I think that that's a trend you need to pay attention to, because it's been happening for a little bit over a week now. And I think as we get into 2021, everybody I'm talking to, institutional investors are calling me, retail investors, where can we get some yield? Where can we get some income? So if you're someone who's retiring today, where you've got a pension fund, you've got an endowment that you need to get a rate of return, banks are paying you nothing today. Government bonds are paying you nothing today. So what I want to do is just kind of illustrate an example. Again, not a recommendation to buy any specific stock, but I took 3 different stocks that I own personally, we own for some clients, along with many other stocks, to illustrate the point of how income and how dividends are paying investors to stay in the market today. So we've got 3 stocks. I took Coca-Cola, 3M, and Verizon. Everybody knows Coca-Cola, obviously. 3M is Minnesota Mining and Manufacturing, big industrial company, but they also make the Post-it pads that everybody uses. And obviously Verizon, it's either Verizon or AT&T, that most people are using for their sell strategy. And so I wanted to illustrate, we've got a consumer staple company in Coca-Cola, we've got an industrial company, we've got a telecommunications company. So with just 3 stocks, we have sector diversification, but there's one thing in common, and that's the dividend income that they pay. So when we build portfolios for investors, my own portfolio, we're not investing with the same purpose. So when I'm investing in a private company, I was out today doing some research on a private local company. I know that this is a company that needs some investment. It's probably a 3-4 year picture before I start to get a return. I'm not worried about the money that I'm going to get today. When I'm buying a stock like Amazon, for example, I know there's no dividend, obviously, in Amazon because they're continuing to reinvest in themselves. So I'm looking for capital appreciation somewhere down the line. But a good part of my investment portfolio is really set up in something that I'm only really relying on the income that's coming out. Capital appreciation is secondary. And so in my own portfolio, these are 3 stocks that I use where I take that dividend every month and I do something with it, pay bills, invest in something else. But when I do the analysis, I'm doing the analysis and buying these companies, not necessarily because they're going to have huge growth, because Coca-Cola has been around for quite a while. It's not going to do something like Zoom or Amazon, but I'm investing in it because it's paying me and it's stable. So let's take a look at that. Coca-Cola today is giving me 3.3%. The nice thing about Coke is they've increased that dividend for 58 consecutive years. So not only have they been paying me a dividend every year without stopping it, but for 58 years, what they pay me today, every year, year over year, they've continued to give me a raise. That raise has increased just over the last 10 years at 11% annually. So that's pretty nice, right? Inflation's only about 2%. If somebody's paying me Let's call it $100 today. Well, next year that's going to be $111. So when I look at Coca-Cola, stable company, very good balance sheet. We do a lot of research to make sure that those dividends are going to be able to be consistent based off of their free cash flow. But this kind of tells you a little bit, 58 years, 11% annualized raise. That's a pretty attractive company right now. 3M, when you look at that, 3.5%, 62 consecutive years, and they've been increasing that at 14%. Verizon, like I said, we all know, 4.2%, 14 years of an increase, and they've been just under 10% in that increase. So we've got three solid companies that we know pretty much are going to be around at least next year. They have a very good track record of increasing that dividend to their shareholders. So that's a priority of theirs. And we also know that if we were to put together a portfolio and combine three of these, because again, diversification is important, we get a weighted average yield of about 3.7%. So we own three best in breed blue chip companies, and they're paying us 3.7%. Now, where are you going to get 3.7% today? Check your money market account. I just looked at my high yield savings. I'm getting about 0.3%. Some of my money that I have over at a regular bank, I'm getting about 0.0001%. So you're not getting paid anything on your money. Cash is trash today. You don't want to be just sitting on a lot of cash. Get that invested in somewhere where you're getting a yield on your money. And so when you look at the stock market, buying three blue chip companies, I get 3.7%. I always say you've got to look at the risk-free rate. So, okay, Rob, I can get 3.7, but what will the government give me without taking on any risk? Because even though these are stable companies, they have a great track record of paying dividends, they're still stocks. Stocks go up and down. Nothing is guaranteed. So when I look at the risk-free rate, the 10-year bond today is paying 0.78, so just a little over 0.75%. When you look at their annual increase, well, bonds, when you buy a 10-year bond, it's not going to increase. It's going to pay you 0.78% from now, and for the next 10 years, you will not get any increase on that. So what I did was, to prove an example, I illustrated a $100,000 investment. So if I take 100 grand today, I put that into a portfolio. One is just, in the 10-year bond, and one is in those three stocks. What does that look like? Well, $100,000 invested in these three stocks we talked about would yield $3,700 in income to me. And remember, the thing about that is what we're going to project is that income is going to increase every year. So if it's paying $3,700 today, if you look on this, the average has just been a little bit over a 10% increase. I should get about a $370 raise next year. So then that puts me over $4,000 of income going into next year. And that's what you're looking at for an investor, whether it's real estate, stocks, private equity, whatever it is, you're looking for income. That income is what pays your bills. You're looking at the sustainability of that income, and you're looking about the increase of that income, because a dollar that you make today in 5 years is not going to be worth that same dollar because of inflation. So you need income that's stable and income that's rising and predictable. When you look at the 10-year bond, that $100,000 that we put in there is only giving us $780. And next year, $780. The following year, $780. And for the next 10 years, that's all we're going to get. So when you look today at where people are putting their capital, it's not really that difficult to say, hey, this, you don't need to be a chartered financial analyst or CFP or CPA to realize this just seems a lot better to me. $3,700 probably increasing versus $780. And I'll tell you two other things about that. The taxes on this are much more favorable. Depending on your bracket, you'll pay 15 or 20% if you're in the highest rate. So if you're at the 40% tax bracket, 39%, you're going to pay only 20%. On these bonds, they are fully taxable. So if you're in the 40% bracket, you'll be paying twice the amount of tax on that $780 than you would on $3,700. So that makes a lot of sense. Also, let's keep in mind, stocks, every time the stock market has dropped in history, it's been a buying opportunity. Why do I say that? We've had plenty of stock market drops over the last 100 years, but even just this year, we're starting to hit new highs. So we know over time that stocks are going to continue to rise. So more than likely, not only will you have this income, but I feel pretty confident that in 10 years, a basket of blue chip stocks will have some capital appreciation. So now you think about it, well, I've got a ton more income. I have the opportunity for capital appreciation, and I have a more favorable tax situation investing in stocks versus bonds. So this is, a little bit of an oversimplification, but not that much. It goes back to money is going to go where it's treated the best. And today, when you look at a scenario like this, for my money, I feel a lot better investing in things like blue chip stocks or other investments versus putting my money in a money market account earning or nothing, or giving the money to Uncle Sam for 10 years for him to give me 0.75%. So that's one of the reasons, one of the key reasons in my view, that the market continues to be really resilient here. And although we have these ups and downs, people are looking for these stock market drops to reallocate capital. So dividends, the sustainability and income as an investor is very important. That's the lesson for this Friday. Have a great week. We'll talk to you next Friday. Until next week, continued health and wealth. I'm Rob Luna. This is Wealth Talk. If you haven't signed up yet, I give information like this for free every single Friday. Sign up at the link below. You'll get an email notification every time there's new content out there. Love to get your questions and feedback for different topics that we could talk about. Have a great weekend.